Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Tuesday, the 27th day of May, 2014, and this is the daily report for gold and silver. Gold and silver tumbling lower today on news that the U.S. economy is picking up and a de-escalation in the conflict over in the Ukraine. Dramatic sell-off in gold, off almost $30 on the day. As you can see, $1264.94 puts it off about $27, $28 on the day. The low $63.50, the high $93.20. And as you can see from this 240-minute chart, we have had that dramatic breakout that we were looking for. It broke to the downside, but as we've talked about over the last couple of weeks, the theory behind this particular pattern is that as it approaches the apex, you get a release of energy, and that release of energy gets a pretty sizable move either to the upside or downside. We'll talk about that. We will talk about where we think this market is going, all on today's daily report. Silver, fairly sizable move up off almost 40 cents, just trailing right around $19 per ounce, the low $18.94, the high $19.49, currently trading $19.05 and change. More on silver towards the end of the show. Before we get to long-term implications of this price drop today, where we think the market might be going, want to talk about the trade that we just got stopped out of. If you recall, right before the three-day holiday, we trailed that stop to just below 83, a couple of dollars below, call it 81, call it 80. That's where we were stopped out in at 92, out at 80, loss on that, roughly $12 on the trade. My sense was, over this weekend with the elections coming up, that if the market was going to break hard to the upside, we were protected. If it was going to break hard to the downside, we were going to get out at the point in which it really breaks through. And so we are out. We are out with the small loss, but it is a loss nonetheless. Now, where do we think this market is going, and what do we think we can look for over the next couple of days as well as weeks? Well, first of all, when we take a look at this market, you can see that it has fallen to a fairly significant level, that level being the 61% retracement. Now, the 61% retracement is of the entire rally that we had, that rally taking us a couple of $100 higher, dramatic rally. And you can see that at least for the time being, it has kind of stalled right in this area. So it's a very logical area for this to be in terms of a first primary move to the downside. My sense is that we're probably going to get a little bit more downside, because now that we've threatened this particular area here and we've broken very, very solidly, very aggressively, very, very decisively to the downside, we've got a couple of targets that we'll look for, and for that we're going to have to pull up a different chart. So what I've done is I've brought up our daily chart, and you can see much more eloquently on this chart what we're talking about in terms of the retracement. This is the beginning of the rally, starts the beginning of 2014, and it takes the market from roughly 1180 to roughly 1391. When we consider the retracement that is now in place at 1261, market trading 1264, that is a 61% retracement of this particular rally. So it is in line in terms of the maximum we could see this market move and still be in any way construed to be bullish. This could be a game changer, and that a break below this is going to signal a return to a bearish scenario, and we've negated much of the gains that we got throughout the first year, because when you consider the move up taking us to almost 1400, we are back below 1300 and back decisively below that. This move really is a signaling of the potential of lower pricing. Now, in terms of where the market could go, we'll have to look at another chart, but my sense is that we'll find some sort of short-term support in this area, but we'll probably then break through that. Now, we'll have to see what develops over the next couple of days, but this is a dramatic break, and it's a dramatic break to the downside. When we considered the fact that we were in that compression triangle, we were looking for a break, we were anticipating that break might be to the upside. Absolutely the wrong way, because the market broke to the downside. But we did see that dynamic spike or break that we were looking for nonetheless. So just to give you an idea of the dramatic fall that we've witnessed, this one-day fall, we've pulled up a 60-minute chart, standard candlestick format, and the criteria, or the characteristics, I should say, of this market have been absolutely sideways. You can see that this is going back to the 22nd, 21st tier market. This is the last high we hit at 1305. We had a 1312 in there also, but we had a series of lower highs, a series of higher lows, and you can see that as this market absorbed this news and reopened after that 3-day weekend, we had this dramatic fall from grace, almost all red candles. Doesn't look like we've got any kind of a recovery whatsoever. We didn't see a market that was characteristics where it spiked down, retraced a little bit to the upside counter trend, and then back down. We saw pretty much a dramatic fall from the price of just under 1,300 per ounce to fall to almost the mid-range of the 1200s, being at 1264, trading roughly $1 off the lows. So traders, where do we think this market might head to? Well, my rough number is roughly 1242. There's a couple of different ways that I've come to that conclusion. Looking at a 2-day chart, this is the chart in which we have our Andrews pitchfork. We talked about the fact that we really saw in this at this point was an absolute fake out, but we saw the fact that for the first time since we put this chart together, we actually saw it break above, for the shortest period of time, this zero prong. We have the zero prong and then of course the 100. Now, when we look at that, what we have found is that typically when this market will drop, it will find support at one of these levels. Now, this is the 23% level. And if you notice, I've put in a straight horizontal line. The straight horizontal line is simply where they would intersect. And then, of course, the best way to determine where that is, we'll have to put up a different kind of a pointer. We'll go to our crosshair. But when we go to our crosshair, you'll notice that this falls in roughly at, call it 36 to 35. So that's one number that we're coming up with. And that's simply based on the idea or the assumption that as this market comes down, if it continues under pressure, and realize you can see it just trading sideways here, really not resting or not using this upper resistance or this lower support here. But if in fact it comes to rest on this most recent sell-off at the particular 23% level, because the fact is, traders, we're still in this cascading down spiral that really began at about 1800. But if in fact that happens, we can be looking for around 1240 as a potential bottom in the market. So that's one study and one way to determine where we think this market could resolve this particular pressure that we have now. Now, another study that we'll look at is going to be a straight Fibonacci retracement. When we look at this retracement again, this is the move that we had from the end of last year, beginning of 2014, in which we saw the market move 1180 to 1391. We've calculated the 61% retracement, that's 62. If that breaks, our next logical move is 76. A 76% retracement, again, that takes you to 1232. So we've got these the mid 30s, low 30s, and low 40s kind of coming in, not only on the last study that we did, but also on this particular study. And then the last study that we'll look at today for gold in terms of where we think that it might go is a weekly chart. This weekly chart, of course, has a multitude of different fib retracement points. We talked about the fact that my belief was that because we had this harmonics right in here, this was a pretty critical area. Once that area has been violated, so to speak, we're going to look at the next area, and that's this particular retracement, and it comes in at 1229. So again, we're getting a lot of reads right around 1230 to as high as 1241. And so traders, that's where I really think we could see the price of gold go to over the next short-term period. It certainly could remain under pressure, And if it breaks below 62, which I have all beliefs that it probably will, the next real level has got to be that 76% retracement level. We talked about that's 32. We see 29 here. And then we also saw 32, 33, I believe, when we looked at the Andrews Pitchfork in the 23% cascading support line. So all in all, when we look at all of these studies together, it really bodes for lower pricing in gold. And as I said, in terms of where we think that structure could take us, that could be as low as 29, 32 to as high as maybe 41, 42. So traders, what does that say for silver? We're looking at a daily chart. This is a spot market of silver, and we've had this dynamic break trading at around just above 1900. That's right in here. My sense is that we have a couple of bottoms in this area, with this extreme bottom at 1870. We've had a low of 1898. If it in fact continues to fall under pressure with silver, it almost certainly has to test 1870, and from there we're going to have to look at some other studies, because the next real low in the market comes in just at around $18 per ounce, and that's based upon this low that we hit, and this, if you look, is back in July and August of last year. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow on Wednesday for another daily update and review. Bye-bye.